All right, let's talk about real estate. For so many people, it feels like the ultimate investment. But how you get into it, well, that's where things get interesting. Today, we're staging the ultimate investment showdown, REITs versus owning a property yourself. Think of it as Wall Street versus Main Street. One is about buying a piece of a massive portfolio with a click of a button. The other is about holding the keys to your very own building. Two totally different paths to the same goal. So, which one is right for you? Let's find out.
So let me ask you a question. You see a giant gleaming skyscraper in the middle of a city, right? You know it's making a ton of money from all those corporate tenants. And you think, man, I'd love a piece of that. But let's be honest, you and I don't have a spare $1 billion to just go and buy it. This is the exact problem we're talking about today. And our two contenders offer two very different and frankly, brilliant solutions.
So here's how we're going to do this. We're going to treat this like a real showdown, a head-to-head battle. We'll compare these two investment styles round by round, looking at what really matters for you, the investor. By the time we're done, you'll know exactly which corner you belong in.
Okay, before we start the fight, we've got to introduce the combatants. In one corner, we have the polished, sophisticated pro from Wall Street. And in the other corner, we have the gritty, hands-on entrepreneur from Main Street, building an empire one door at a time.
First up, let's meet the REIT. That stands for Real Estate Investment Trust. This is our Wall Street pro. The easiest way to think about a REIT is like a mutual fund, but for properties instead of stocks. It's a huge company that takes money from tons of investors like you and me and uses it to buy and manage a giant portfolio of real estate. We're talking everything from apartment buildings and shopping malls to cell towers and data centers. You buy a share of this company on the stock market just like you would a share of, say, Tesla. And here's the kicker. By law, REITs have to pay out at least 90% of their taxable income to you, the shareholder, in the form of dividends. It's professional, it's liquid, and for you, it's completely hands-off. And in the other corner, we have direct ownership, our Main Street mogul. This is the classic way to invest in real estate. It's what you probably picture. You go out, find a duplex or a small apartment building, get a loan, and you buy it. You own the deed, the bricks, the land, the whole thing. You are the boss. You call all the shots. But, and this is a big but, that also means you carry all the responsibility. Every success is yours, but so is every problem. Okay, so here's the tale of the tape before the first round. The Wall Street Pro, the REITs, is for the passive investor. You get instant diversification across maybe hundreds of properties, and you can get started with very little money. The Main Street mogul, direct ownership, is for the active operator. Your investment is concentrated in one single asset, and it's going to cost you a whole lot more to get in the game. You can already feel the tension between these two completely different philosophies. All right, introductions are over. It's time for the main event. We're going to pit these two against each other in 5 critical rounds. How much money you need, how easy it is to get your money out, how much work is involved, how much control you have, and of course, the taxes. Let's get it on. Ding ding. Round 1, capital required. And wow, this is a first round knockout. It's not even a fair fight. You can see right here, you can buy a share of a REIT for $100, maybe even less. It's as easy as buying a stock. But direct ownership, that $50,000 bar on the chart, that's not the price of the house. That's just the down payment for pretty average property. On top of that, you're going to need thousands more for closing costs, inspections, and a cash buffer for when something inevitably breaks the first month you own it. So for just getting started, for pure accessibility, the REIT wins this round hands down, no debate. Let's move on to round 2, liquidity. Now, liquidity is just a fancy word for how fast you can turn your investment back into cold, hard cash. Let's say you have a sudden emergency, or maybe a dream business opportunity comes along and you need money now. With a REIT, no problem. You open your brokerage app, hit sell, and that money is in your bank account in a couple of days. It's incredibly liquid. Direct ownership, it's the complete opposite. It's famously illiquid. Selling a physical property is a long, slow dance. You've got to find an agent, prep the house, do showings, negotiate offers, go through inspections, appraisals. It can take months. In a slow market, it might even take a year or more. For sheer flexibility, REITs take another round easily. Round 3 is all about the management burden. And this is where we really see the lifestyle difference. With a REIT, your job is done the second you buy the share. A whole team of professionals is handling everything: the tenants, the leaky roofs, the legal paperwork, all of it. With direct ownership, you are the management team. You're the one dealing with what landlords call the 3 T's: tenants, toilets, and trash. You're the one getting that call at 2 in the morning because a pipe burst. Now sure, you can hire a property manager to handle the day-to-day, but they'll skim 8 to 12% of your rental income right off the top, and you still have to approve any big expensive repairs. For truly passive experience, the REIT wins again.
But wait, just when it looks like a clean sweep, direct ownership comes roaring back in round 4, control and leverage. See, as a REIT investor, you have zero control. You're just along for the ride. But as a direct owner, you're in the driver's seat. You decide who rents from you, how much to charge, when to renovate. You have total control. And even more important is leverage. You can go to a bank and get a mortgage to buy let's say, a $250,000 property with just $50,000 of your own money. Now, if that property goes up in value by just 10% to $275,000, your property value increased by $25K. But since you only put in $50,000 of your own cash, that's a 50% return on your initial investment. That ability to use the bank's money to magnify your gains is a superpower. This round goes to direct ownership, big time.
And now for the final round, tax benefits. This is another huge win for our Main Street mogul. REIT dividends, they're usually taxed as regular income, which is often the highest rate you can pay. But with direct ownership, the tax code becomes your best friend. The government literally gives you incentives to provide housing. You can deduct your mortgage interest, your property taxes, insurance, repairs, almost everything. But the real superstar, the secret weapon, is something called depreciation. The IRS lets you pretend your building is losing value over time due to wear and tear, even if it's actually going up in value. This creates a paper loss that can often reduce your taxable income to zero, even while you're collecting positive cash flow every month. It's an incredible advantage that REITs just can't offer. Direct ownership takes the final round in a landslide. The bell has rung for the last time. That was 5 intense rounds, and both of our contenders showed where they shine. They both landed some serious punches. So let's go to the judges' table and see the official scorecard. Take a look at this. It's fascinating, right? It's not a blowout for one side. It's a tale of two completely different specialists. REITs absolutely dominate when it comes to convenience and simplicity. They win on needing less money, being easy to sell, having someone else do the work, and being diversified. But direct ownership comes back and wins big on the things that give an investor real power: total control over the asset, the ability to use leverage to supercharge returns, and those game-changing tax benefits. This is a classic split decision. So, after all that, who's the real winner? Well, here's the thing. There is no single winner. The real champion is the one that fits your life, your finances, and, honestly, your personality. So let's figure out which champion you should be choosing. You should go with the Wall Street Pro, with REITs, if you want your real estate investing to be completely passive, if you want your money to work for you in the background while you focus on your job, your family, your life, this is your play. If you don't have a huge chunk of cash to start with, if you need the option to sell quickly, and if you love the idea of owning a tiny piece of hundreds of properties on day one, the REIT is your champion. It's designed for simplicity.
But you should go with the Main Street mogul with direct ownership if you have that entrepreneurial spark. If you want to be in command, making the decisions, and actively building the value of your asset through smart choices, if your main goal is to crush it on taxes and use leverage to shoot for incredible returns, this is your path. This isn't just an investment for you. It's a hands-on business you want to build.
But hold on, I've got one final twist for you. What if this isn't an either-or choice? What if the smartest investors don't pick a side at all? What if they get both of these champions to fight for them on the same team? And that brings us to the hybrid strategy. A lot of very smart people do this. Think of it like this. You use a broad, diversified REIT fund as the stable core of your portfolio. This gives you that liquidity and broad market exposure. Then you add 1 or 2 directly owned properties as your satellites. These are your special projects, the places where you can get your hands dirty, force appreciation, use leverage, and take full advantage of those amazing tax benefits. You get the best of both worlds, the stability and passivity of Wall Street combined with the control and wealth-building power of Main Street. I'll leave you with this fantastic quote from the billionaire investor Ken Griffin. He said, "Real estate creates millionaires quietly. REITs let you participate without the 3 a.m. toilet calls." And that really just says it all, doesn't it? So the question isn't which one is better. The question is, what's the right mix for you and the future you want to build? Thanks for joining me for this explainer.